After the bankruptcy of Silicon Valley Bank, now there is fourth bank that is also threatened with the same problem. First Republic Bank. Now this has once again sparked fears of the banking crisis that hit America lately and further raised fears of a full-blown banking failure such as at the beginning of 2008 Great Recession. I have explained the differences between the current crisis and 2008 Great Recessions in the previous video. However, the video was only published in Bahasa Indonesia. In this video, however, I tried to make it in two languages. One in Bahasa Indonesia. For those interested in Bahasa Indonesia, you may want to check in the link card above. Now, this video once again reiterates my argument on this matter that this crisis is actually different than what happened in 2008. Now, let's discuss one by one on the analysis circulating in social media regarding the main cause of the bankruptcy of these American regional banks. First analysis is the cause of Silvergate's Signature and SVB's bankruptcy was due to the fractional reserve banking system. The camp that adheres to this view usually comes from the crypto community. This is understandable because Bitcoin itself was born as a reaction to the failure of the fractional reserve banking system back in 2008 Great Recession. I will try to explain this fractional reserve banking system in a simple way so that all of you can also understand the banking system adopted by everyone in the world these days. Now, let's say there is Andy. He deposited his money, $10,000 in Bank X. Then comes Brian. He borrows money from Bank X and Bank X lent him $9,000 which is actually came from Andy's deposit. Brian then used the money he borrowed in the amount of $9,000 to buy a car from Charlie, and Charlie put the money from the sale of his car to Bank X. The total balance of Bank X is now $19,000. Then came Diana, who wanted to borrow money from the bank, and the bank then lent her $8,100 out of Charlie's savings. She then used the money to buy a machine from Eddie, and Eddie then kept the money from his revenue of $8,100 back in Bank X. Bank X total balance now is $10,000 from Andy's savings, $9,000 from Charlie's savings, and $8,100 of Eddie's savings, which add up a total $27,100. In fact, do you remember that the real cash is actually only $10,000? And we're gonna call this $10,000 as M0, the real cash, real physical cash. Meanwhile, assuming all savings, including Andy, Charlie, and Eddie, are ordinary savings that can be withdrawn at any time by them, the total balance now will be $27,100, and we're going to call this $27,100 as M1. If later Bank X uses a portion of this M1 to invest, for example, $10,000 in government bonds, in this regard, for instance, US Treasury bonds, then now the money supply becoming total M1 of $27,100 plus $10,000 from the Treasury, and now the total money in circulation becoming $37,100, and now we're gonna call this $37,100 as M2. If you notice, the total money supply is already increased 271% above M0 or real actual physical cash that came from Andy's original deposit. Fractional reserve banking, or FRB, is the magic of the modern banking world. With this system, the economy can move much faster because the money supply is much larger than the existing physical money or real cash. That's the positive side. But if you pay attention carefully, this is called leverage. And leverage always contains risk. What if, for some kind of reason, Andy, Charlie, and Eddie at the same time suddenly withdraw their funds, otherwise known as bank run? Bank X certainly doesn't have sufficient cash to pay Andy, Charlie, and Eddie all at once. A very shocking situation for all depositors where the amount of cash available in their bank is actually insufficient. At this moment, you may start wondering, does it mean that if all depositors of all the banks in the world withdraw their money at the same time, then the available money in the banks will not be sufficient? The answer is unfortunately yes. It is theoretically true. But the question is, why suddenly a bank's customers simultaneously withdraw their funds all at once? The answer is because there is a crisis of trust. For some kind of reasons, the bank's customer feel it is no longer safe to keep their money in the bank anymore. If the fractional reserve banking system is the sole cause for the bankruptcy of Silvergate, Signature, and Silicon Valley Bank, then why, in the SVB case, SVB customers flock to withdraw their funds from SVB as well as other regional banks and transfer them to much bigger national banks such as JP Morgan, Citibank, Morgan Stanley, Bank of America, Wells Fargo, and other banks which are much bigger than SVB. There is even a term for this, and this is called flight to quality. If fractional reserve banking is the only cause of Silvergate, Signature, and SVB's failure, then why flight to quality? Other banks should also have the same potential risk, which is FRB. But why do these regional banks customers put their funds back into other banks that also use the same potential problematic fractional reserve banking system? Clearly, fractional reserve banking system is not the main reason that caused 2023 banking crisis. So now let's move to the second analysis. Second analysis, the cause of SVB and regional banks bankruptcy was because the Fed raised the Fed fund rate very aggressively. Now, back in 2020, in plain view, SVB and regional banks in America, since the Fed implemented quantitative easing in 2020 to prevent economic freeze due to the COVID-19 pandemic, have experienced a very large increase in the flow of funds. In the case of SVB, the growth of tech startups funded by venture capitals resulted in SVB growing enormously rapidly. It is not coincidence both SVB and tech startups are mainly located in Silicon Valley. SVB then invests these funds in US 30-year Treasury bonds, which is the safest investment in the world. In contrast to 2008, Lehman Brothers invested its fund in high-risk assets, namely the mortgage-backed security called CDO, generated from subprime mortgage, which we all know later becoming defaulted. You are of course asking, if SVB invests in high-quality bonds, then how come it went bankrupt? The answer is because in 2020 to 2021 period, US Treasury bonds have very small interest, which was actually not a problem because at maturity, SVB will get back the principal along with the interest. However, in 2022, the Fed is raising interest rate aggressively. Within 1 year, the Fed has raised interest rate from 0.25 to 4.75, the fastest rate hike since 1980. If the Fed hiked the interest rate, then the US 30-year Treasury bonds held by SVB will decrease in value. Because everyone now will start thinking, why buy government bonds from SVB? While if they just buy it from the treasuries, they will definitely get much higher coupon. Please remember that the decline in the value of Treasury bonds assets owned by SVB is actually unrealized loss, and therefore, it did not need to be recorded in the financial statement until they were forced to sell it. This is because if these bonds are held by SVB until maturity, then they will get back the whole principal along with the interest, resulting no loss at all. In fact, they make some money. However, the problem was started when the Fed raised interest rates and there were so many troubled startups, forcing them to withdraw their funds. For example, to pay severance pay for their employees because they were forced to lay off hundreds of even thousands of workers. Now, remember the FRB principle I explained at the beginning. When there is a massive withdrawal of funds, the cash funds available at the bank, the M0, of course, will not be sufficient. M1 is always much bigger than M0. This made SVB forced to place all of its treasury bonds assets in ASF, or Asset for Sale status. And this was done when the value of the treasury bonds has dropped significantly since the early 2022. SVB was forced to cut loss. And in the case of SVB, this has increasingly triggered all other SVB customers to withdraw funds in large numbers. SVB then collapsed. This second analysis is the most widely circulated in mainstream media, social media, among startup activists and society in general. And now we come to the third analysis, the deregulation of the Dodd-Frank Act during Donald Trump presidency. Even though it sounds the most political from all the three analyses, in my opinion, this is the most logical one. After the 2008 crisis, Senator Barack Obama succeeded in becoming president to replace George W. Bush. During the two periods of this tenure, there were many reforms he made. One of them is the Dodd-Frank Wall Street Reform and Consumer Protection Act. Through the Dodd-Frank Act, Obama laid a very solid foundation for the American banking system and at the same time restored financial stability. With his new law, the Fed is required to impose a series of very strict stress tests on all banks with assets above $50 billion every single year. The aim is that if a crisis occurs, all these banks will have sufficient cash funds if customers withdraw their funds on a large scale. However, the Dodd-Frank Act was challenged by several banks owners who tried to lobby Congress to provide concessions. The strict rules contained in the Dodd-Frank Act made it difficult for the regional banks to grow, especially if they had to compete with giant banks. Greg Becker, the CEO of Silicon Valley Bank, is one of those who has vociferously voiced this deregulation proposal. In 2017, Donald Trump replaced Obama and became the 45th President of America. During the Trump administrations, there were many regulations that were born under Obama which were then amended again. The Dodd-Frank Act, unfortunately, is one of them. On May 24, 2018, Trump signed a new law which in principle rolled back the Dodd-Frank Act on banks with assets below $250 billion. Since then, all regional banks with assets below $250 billion are no longer required to undergo the annual stress test by the Fed as stated in the Dodd-Frank Act. That's why if you see why the American banks that currently in trouble are only the regional banks with an asset value of under $250 billion, a group of banks that have never been conducting stress tests since May 24, 2018, the day the bill was signed by Donald Trump. This Trump's regional banks deregulation policy reminds me of the Indonesian monetary crisis that took place in 1998. If many of us Indonesians complain about the exchange rates of the rupiah against the US dollars, it was in this particular year, that the value of the rupiah dropped drastically. Within just few months, the US dollar exchange rate shot up from 2,380 rupiah per dollar to 16,650 rupiah per dollar. There were 16 banks closed in the period of 1997-1998. 38 banks in 1999, and 3 more banks were liquidated in 2004-2005. There are many analyses of the crisis of confidence that occurred at this time. However, if we look back in our history, 1988, Bank Indonesia, our central bank, launched something called Pakto, Paket Oktober 1988, and we call it Pakto 88. One of the fundamental basic provisions in Pakto 88 was that it was easier to establish a national private bank with only a minimum capital of 10 billion rupiahs or around $4.2 million during that time. Everyone can establish a commercial bank. As for the establishment of People's Credit Bank or Bank Perkreditan Rakyat, BPR, a minimum capital of only 50 million rupiahs or around $12,000 only should be sufficient. History proves that Pakto 88 was actually a time bomb that exploded 10 years later. That was during the 1998 crisis. This is, I believe, the time when America should be humble and start learning from Indonesia's history. Be careful with the deregulation of the banking system. The fractional reserve banking system itself has already contained very high leverage on the macroeconomic carried out through the monetary world. All leverage naturally contains risk, and the only way to manage this risk is through regulation. So now, we come to the conclusion. Currently, there are 3 opinions about the causes of bankruptcy of these regional banks in America: Silvergate Bank, Signature Bank, and Silicon Valley Bank. The first is fractional reserve banking. The second is because the Fed raised interest rate aggressively. And the third is because of the deregulation of regional banks under Donald Trump. All 3 are certainly influential. But in your opinion, out of these 3, which has the most influence in causing the bankruptcy failure of the regional banks in America that happened lately? Let's discuss it in the comment section below. And by the way, this is the first time I made video in English, so I do apologize for any mispronunciation or grammatical error. English is not my main language. Thank you so much for watching this video. Hope you all enjoy this video. Kindly support us with your thumbs up and subscribe to our channels. Bye-bye.